KDKR Decatur, Dallas, Fort Worth. KYJC Commerce. KMWC Bethany. Portions of KDKR programming do not necessarily reflect the views of this station, its management, or staff.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
So what is the latest on real estate in North Texas? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Well, real estate has been through its ups and downs as of late. What does the immediate future look like? Mortgage consultant Mark Pfeiffer is here to give us his take. Mark, always good to have you on the program.
And it's always good being here, Mr. Bob.
Okay, so let's talk here. Let's look at the past couple of years. And obviously 2024 has been an interesting one, and especially after this last 5 days, which we'll get to that in a second as well. But I wonder what the difference, how your years have gone between how things were in 22, how things were in 23 compared to how things are today. I mean, and then what do you see 25 looking like?
Bob, how much time do you got?
Yeah, try to keep it brief, okay?
Yeah, no, I'm with you.
I'm just kidding.
No, it's probably what generically speaking, big picture, you probably know it as well as I do, right? COVID hit, real estate market went nuts, mortgage market went nuts, just things went crazy for about 2 years, and then call it last year, and for the most part this year as well, it's not been quite the layup it once was. And the reason being is the obvious of just affordability, right? House prices, I mean, we've seen it here just in Dallas-Fort Worth, just how much they've gone up in the last 4 or 5 years, right? Now, the reality is, this is the part we try to educate our buyers and the wannabe buyers out there, which is, the sales price or the purchase price is forever and the interest rate is temporary, because affordability's got two parts to it that's hitting it right now. One is the rates, right? Rates are higher than they were accustomed to seeing here in the last decade or two. And then two, with that, the cost of the housing. But the reality is, well, we'll talk about that in a moment, I'm sure, with the headlines of where, housing bubble, all that stuff, air quotes. But the reality is, generically speaking, Dallas-Fort Worth has been a really good market, and we're still, I don't see any bubble here, and houses are still expensive, and I don't see them getting any cheaper anytime soon. So it's been an interesting last year and a half to compare, and where do I think it's going in the future? Again, I think that's going to depend on where rates go, and I do think they're coming down. So that's the good news is I think the worst is behind us in terms of rates for the near future. So we'll see if I'm right, but that's my prediction.
So let's talk a little bit about current rates. Obviously, just the last couple of days, we've really seen rates come down. Talk about what the effect has been on mortgage rates. Today, for instance, as we went through a pretty good drop in the 10-year today, but this compared to last week.
Yeah, so just in the last, to put it in perspective for those listening, I'll answer the weekly question here in a second, but big picture, let's just take this year. So the 7 months that we've completed so far this year, rates have been around that 7% range. And we've been talking, month over month, have been dropping down a little bit, but just since July. I mean, if you look for July, we went from low sevens to suddenly now the mid to high sixes all of a sudden. And the big part this last week, especially yesterday, is the Fed is basically forecasted that they do think that they're going to start cutting rates in September. We've seen data that says the job market's not quite as good as it was, and that inflation has in fact been coming down, not quite to their target, but at the end of the day, inflation looks like it's coming down and will continue to come down. You and I have been discussing that. So the combo of the weak jobs market, inflation coming down, and the Fed finally acknowledging that, I think has just really helped the market understand that the time is finally here where the Fed's going to be a little bit more accommodating. Of course, they put their wording saying they can change their mind, data dependent, all that stuff. But the reality is the Fed's going to cut rates next month. And while that doesn't impact long-term mortgage rates, it certainly correlates. And it's a good thing for rates to come in the future, for sure.
So tell me where you stand on the Fed. And I'll tell you where I do, and we'll see what the differences are. I look at they're in a very awkward situation because it's kind of one of these things. They're just trying to make everybody happy. just to do that one. And 25 basis points or a quarter of a percent drop in interest rates doesn't really even move the needle. But and you got the politics of the election cycle right and dab in the middle of all this. So I'm thinking, I think that there's still even a 50-50 shot that they don't do it, just depending on the data. But at 25 basis points max, then I'm not so sure we don't see anything for another 2 or 3 months, just because of. I believe that inflation is at a point right now where we're not going to see continue rising prices. But a lot of the stuff they're doing in the background could end up spurring another round of inflation. Where do you stand on all that?
Yeah, I think a couple things to dissect there. But I will say as a whole, I agree with you. The 25 basis points is not going to really move the needle. I think all it really is just the sign of the first step, because Jay Powell did describe it as a process. I mean, it's not just a one and done. So it's the start of more to come. The question is, to your point, is the timing. I started out this year, and we'll see if I change my tune, but, days like yesterday certainly might have me change my tune, but I've been resolute for the first 6 months of the year, 7 months of the year, that I do think rates are going to, I predicted the Fed wasn't going to cut till Q4. So it's a little premature. That was just my guess, by the way. Obviously, who knows, right? But the other part is I suspected that mortgage rates, went in somewhere in the mid-sixes. That was kind of my guess. I don't know that I was ballparking the low sixes. If they do start in September, we could see that by the end of the year. As far as the politics, I think some part is just ego too, right? So Jay Powell came in, and this is his last term, so he doesn't want to be known as the guy that didn't do it right. He's trying to achieve that soft landing. So I think some of it's politics, some of it's optics. At the end of the day, I just know that it's coming, whether it's in the next 6 months, 12 months, or 18 months. I do foresee lower interest rates ahead for the mortgage world, which is going to help a lot of home buyers. But also, I think to your point, lower rate, lower cost of borrowing, while it's good, goes back to spurring more inflation and more house appreciation. Because you bring out more buyers are now going to be competing for this limited supply we already have, and that's going to drive rates even higher, which is why it's a good time to buy now. Like going back to my previous statement, sales price, what you pay for it, is permanent. Right, but you can always refinance. So if you buy a mortgage today or buy a house today with a mortgage, you can always refinance that, because when rates do come down, terrific. But man, when they come down, if you haven't, you're not competing with everybody else coming out of the woodwork.
So if I came to your office today and said, hey, there's this house I want to buy, go ahead and get me approved, and I sign the dotted line, what kind of rate could I get?
Yeah, so the Mortgage News Daily, I always quote that one. Not that I advocate it, and I would say to a listener, don't go click anything on there if you look at inundated with spam. But it's just the best to use for just the layman. So notice this, because my compliance department won't let me quote rates, but I will say their website right now, I got it pulled up, 6.62 is what they're showing their rate to be. Now that could have points and all that stuff, but it's indicative of call it the mid-6 range of a point, but call it the mid-6 to high 6. I don't love paying points if you can avoid it if you're buying a house today. It's another topic, another time. But to answer your question directly, call it the mid to high 6s, as opposed to what you were seeing even a month ago in the 7s. So
if you talk a little bit about, you kind of segued right into my next question. What about taking points? I mean, does that ever make sense? How does it work? I mean, what are we looking at? I mean, do you get a very good value for that?
Good question. So points, almost pre-COVID, I can't remember the last time we did points where made a whole lot of sense until COVID hit and the rates dropped, to really, really low. When rates are in that 3% range, it made sense to pay points, because in all likelihood, if you're buying that house, you're going to be there for a while, you aren't going to be refinancing off a 3% or 4% rate. In today's terms, to answer your question directly, for today's rates, whether it's 7, 6.5, or even 6, I don't love the idea of paying points if you can help it, simply because you may not have this mortgage for longer than 12 to 24 months. Because even if you're buying today, even though 6.5 is better than 7, for those that don't know, points is just money you pay up front to get a lower interest rate. You're paying money at closing in exchange for that money. You're getting a lower interest rate. Some programs, you have to pay points. It is what it is. But if you can avoid them in general, I would say try to do so in this market, because I do believe, and I think a lot of folks would agree, that I think in the next 12 to 24 months, rates will be lower than today. So don't pay extra money today to get an artificially lower rate. grin and bear it, take the higher rate, keep the money in your pocket, and then when rates get to the point where it's favorable to refinance, reassess and determine if it's good. The paying points is good if you think rates are as low as they're going to be and refinancing on the horizon. I would say avoid them. When rates are hard, it's that middle ground where it's really hard to know whether you should or shouldn't. And that's just using that crystal ball and running the numbers to see if it makes sense at that time.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. Mortgage consultant Mark Pfeiffer is here with me today, as he is every month, to talk a little bit about what's going on with real estate. Let's talk about, the person who bought who got into the mortgage at the peak, whatever that was, 7.5, 7.75.
Yeah, 8, right?
8 was it did break the 8. Okay, so let's say the person that person is staring right at that 8% mortgage is today, and I know you're not giving advice. I want to make sure that everybody knows that. Is it a good time to refinance today, or should you maybe bet on it going lower?
Great question. So that's I would say. I'll answer the question directly, and then I'll put my little asterisk and explain more. But, yeah, if you got an 8% rate, absolutely look into saving some money today. Here's my asterisk. Let's just pretend you can get down to rates somewhere in the mid-6s. I even heard of a mortgage person last week say, I'll sell somebody a 20-year note because those have started to come back. They're shorter-term mortgages, so I don't know if that's something I'd recommend or not. I haven't done enough homework to know. But the answer is if somebody's got an 8% rate, is it worth refinancing when they got a 6-point whatever? I think it's absolutely worth exploring. I remember, I'll give you my personal story, and this would have been back in 2006 through 2009, give or take. I think I refinanced my home 4 times in that time period. When I bought my house at that time, my rate was I think it was 6.6, or it could have been, by the time I took a 6.9 rate because I didn't pay any cost. Well, then I refinanced from 6.9, I don't remember the exact numbers, to, let's say, 6. And then from 6 to 5.5, and then from 5.5 to 5. So there are instances where it can. I would just say be very careful, right? Be very, very careful about who you're working with and the motive behind it. If it's for a mortgage person to get paid, or are they actually helping you? Because there's a right way and wrong way to determine whether refinance makes sense. So while I do see rates going lower, there's always that cost analysis you got to run to say, is it worth waiting or not? Because to go from 8.2 to 6.5 can save you some real money, right? And a lot of right now refinances that are going on are cash outs, because this is the other part, Bob. Employment's still relatively low. Unemployment's still relatively low, so people are employed, and they have this massive amount of equity in their home because of what's happened over the last few years, but they also right now have massive credit card debt. We're at an all-time high for credit card debt in our country. So a lot of folks are refinancing right now. So maybe you are trading that 8 for a 6.5 or 7, not just for the savings on your actual mortgage payment, but maybe you can do some really good things and pay off some debt and create some cash flow in the process of doing that. So there's a lot of opportunities. So should they look at it? Yes, definitely explore it. Should they pull the trigger? Depends on your scenario, and just talk to a mortgage professional you know, like, and trust.
Yeah, I guess, one of the things we always talk about, the numbers, the nice thing about this, and if you do a comparison, the numbers are black and white. It's not a gray type situation. It's very black and white. Just make sure, just to say what you just said in another way, make sure that you're seeing all the black and white and that you know exactly what the numbers mean. Now, you were talking about, or let me say it this way, we're hearing a lot of, or seeing a lot of commercials on home equity loans and cashing out that equity like you were talking about. How do you know if you're getting a good rate? I mean, I couldn't even tell you this, generally the costs in doing a loan like that.
So there's two, this is a two answer. And the reason being is you can do a first lien, like what's called a big one, a big mortgage, an air quote normal mortgage, home equity loan, where you go in and take cash out and you reposition everything. Or what's very popular right now is you leave your first mortgage alone and you go get a second mortgage, like a baby mortgage, a junior mortgage, right? It's still the same thing, still a mortgage on the home. It's just sitting there behind the existing one. That's very popular because somebody right now will have a 3-point something, 4-point something on their first mortgage, and they don't want to touch it for that second. Those are two similar but different things. The seconds make a lot of sense because you don't have to refinance that higher rate. Here's what everybody needs to know. Texas is unlike any other country, We are our own country, right? We're like any other state in the country. and that if you get a cash out loan, whether it's a first or a second, you cannot, by Texas law, you cannot refinance and take cash out again for a 12-month period. So what I've seen happen in the past is somebody goes out today and they get that baby second lien, and then rates drop, and 6 months from now, 8 months from now, rates are really attractive and they want to refinance, and Texas law won't let them pay that off and refinance that loan. So to answer your question, yes, there's a lot of advertisements because for reasons I just said, like 40%, believe it or not, Bob, I was shocked by this numbers. Now 40% of applications are for refinances, which is crazy to me because rates haven't dropped that much. But it has been, even when rates were at 7, it was about 30% of the market was refinances in the mortgage market, which is nuts because that means it's call centers. My group's not doing that percentage. I wish we were doing more, but we're not. But it's the call centers of the world trying to get folks to pay off their debt and pay this stuff off. So again, it goes back to the make sure you're seeing all the black and white, to use your words. Make sure you're really working with somebody who has your best interest, because to do a loan, man, if you don't do it right, it can really be the wrong thing. So make sure you're talking to somebody you trust and that you've run the real numbers and you see all the data before pulling the trigger and making that decision.
So I don't think. Tell me what the logic is behind the state of Texas not allowing that to be done before 12 months is up. It just
yeah. So Texas has a bunch. A Texas cash out. It's called an A6. It's the article of the Texas Constitution, and it's goofy. A lot of lenders won't even lend in Texas for this reason, for these type of loans, because they can be very onerous to a lender. But the idea is to protect the homeowner from ourselves. From us, the homeowner, from ourselves. And so the other caveat to that is in Texas, you can't get more than 80% of the home's money. I can't get that more. You can have total loans, totally more than 80% of the home's value. So they want to make sure you have enough equity that if something happens, you can sell it. They want to make sure you don't max yourself out. They don't want, like California during the 06, 07, 08 crash. They don't want it to where it's like you maxed out your financing and then the home values drop and you're in trouble. So in a weird way, I get it. But at the same time, like, I'm an adult. I own a home. It's my job. But Texas won't let you get more than 20%. It won't let you refinance for more than until after a year has passed. So it's there to try to make it so people don't keep coming back to the well over and over and over and maxing out their home more than they should.
So we've got the home equity loan. We also have the home equity line of credit. What are the pros and cons when you're comparing the two, trying to figure out which one to secure?
Good question. So the line of credit, for those that don't know, line of credit, think of it like a credit card. If you go get a $40,000 line of credit, let's say it's a second mortgage. You already got your first at 4%. You got a second mortgage sitting that's a brand new one, a home equity line of credit. This actually is a good market to consider that. Reason being is those line of credits, most of the time, vast majority of the time, line of credit implies that the interest rate is going to float. It's going to change. And the reason why this market works is because that rate is, in fact, tied to the Fed. So when the Fed, let's say they do reduce rates next month, if anybody with a line of credit out there, home equity line of credit, their rate will go down. So it's a good market to look at it because I do think, again, as we've discussed, the Fed will be lowering rates in the near future. So a line of credit makes sense. Line of credit typically have lower cost. I'm still going to qualify for them, but they're good and they're options. And the line of credit, the reason what that is like a credit card. If your balance is zero, you don't have a payment. If you go rack up $10,000 because you had to go do some home improvements to it or whatever you want to do with the money, go to Vegas, whatever, then you're going to have a mortgage payment on that $10,000. So it's a line of credit because it can change every month. It can go up or down based on your line. So is this a good time to do it? Absolutely is worth considering. It's probably the most favorable time in the last 20 years for line of credit, just because, again, the cycle of the rates is going to be going down in the near future.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. If you want more information about Mark, go to mortgagemark.com. So if you guys are an extremely important part of the process in the mortgage consulting industry, and the good guys are even more in demand. What about our friends on the real estate side, the people who are selling these properties, the realtors, who I'm also a very big advocate for as well? How are they holding up? Some of the people you've talked to.
Funny enough, I went to a luncheon today where somebody I work with and a leader of a local organization for realtors spoke. And they're similar, right? It's all about buyer education, seller education, making sure that they can be realistic. right? This isn't, one of them told a story about how their brother sold a house 2 years ago and they expect this. Well, that's not today's market. Inventory in Dallas-Fort Worth is up just a touch. I think prices I saw like month over month is down like 2%, or maybe that's year over year. At the end of the day, it's pretty much flat. I mean, I don't consider 2% to be anything monumental. I mean, I get it when it's your money and you're writing the check or not getting that money. It's one thing. But the reality is Dallas-Fort Worth has been pretty stable. There's a little softness, but overall, Dallas-Fort Worth and even the nation, we're still in a balanced market, right? Like, yes, it is now taking 2 months or 3 months to sell a home, where it used to be 2 or 3 days or 2 or 3 hours back in the crazy times. But 2 or 3 months is still a normal supply. I mean, it's only a handful of weekends. So the reality is there's still, we'll see. We're catching up. I saw lots of numbers today about Dallas-Fort Worth up in Salina is going to be putting in thousands, tens of thousands of homes. But there's still technically a housing shortage. A lot of millennials are starting to get married and have babies. That spurs new homes. The peak of the millennial population is hitting that age bracket. So as far as the inventory and realtors are concerned, this is super important. You guys work with somebody you know, like, and trust, just like the mortgage person, because you're right, Bob. It's easy to be a pro. No, I'm sorry. It's easy to be a Joe. It's hard to be a pro, right? Like, find somebody who knows what they're doing and has sold a lot of homes and has your best interest at heart to tell you how to navigate those waters, because it can be tough if you don't have the right person with you.
So I know that you've talked to people who've been to other consultants and then they make their way over to you, maybe to get a second opinion or whatever. And I'm catching you off guard with this question, but maybe off the top of your head, what's the most outrageous thing that you've seen?
Man, I got a good story. The offender shall be named, remain nameless, but everybody would know him if I said him. So this story comes from somebody in my office who had a college buddy. They weren't friends, but they knew each other enough to where this guy reached out and said, "Hey, I'd like to buy a home." They talked. He said he was shopping us with some other, big company. Fine. We get shopped all the time. We recommend it. It's fine. Like, we got nothing to hide, and we're really good at what we do, and we got great, confidence in what we can do and if we can offer. Well, for whatever reason, the buddy just said he's going with company X. Asked why. Oh, no reason, lower rate. Okay. Send us the estimate. Let's make sure it's apples to apples. Guy didn't send it over. So my buddy, my employee, hangs up and calls the wife. Says, "Hey, send me the estimate. I don't believe what I'm hearing." She sends it over. Bob, I don't know how you missed this as a buyer, but company X was charging them $17,000 more than us. And I don't understand how somebody can't see, and again, I've been doing this for 20 years. I'm a little biased. My eyes are trained, and I know what I'm looking for. But in this instance, that buyer was about to proceed with big company X, with commercials and all those other fun things out there, sponsorships of NFL and all that, to pay $17,000. And that's not, $17,000 is the most outrageous. To answer your question, that's the most outrageous. I've seen anything from, I'd say average is thousands. Right, when we see this from certain companies, it's like you just know. And if they're not open and willing to at least share with us what they're being offered, like, let us help you as a professional. Let us help you just compare apples to apples. If we win, we win. If we lose, we lose. But at least you have the right information. But not to share it. That's just not. And again, everybody works differently. That's just not my belief, and that's not how you should work. I think just be open and honest, and I think you're going to get what you pay for. So, but that is. We've talked about marketing and how you can twist it and spin it. It's real. It happens.
I knew I could get a good story out of you, Mark. Great to have you on the program. MortgageMark.com is where you want to go for more information, and we'll talk to you next month.
Thanks, Bob. Have a good night.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. If you got a question for me, please go to the website at prudentmoney.com and send it in, because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.